Welcome to Banking 101, a first principle jargon-free course on banking. The purpose of this short lesson is to integrate our learnings on the financial services industry from lessons 1 and 2 with our learnings on capital markets in lessons 3 and 4. Let's get started. In lessons 1 and 2, we learned the definitions of some key concepts that included financial assets and financial products. We also learned of Type 1 entities that provide financial products, Type 2 entities that enable provision of financial products, and non-financial businesses who sell or enable financial products. In lessons 3 and 4, we defined capital markets where mostly fungible forms of financial assets are exchanged between buyers and sellers. In this lesson we will bring these concepts together. Let us first recap the definitions of financial assets and financial products. A financial asset is a physical or digital symbol that signifies economic value, is accepted across a broad context, and that economic value is derived from a defined rule, instead of intrinsic properties of the symbol. Equity, debt, currency, derivatives and crypto assets are major subcategories. Financial products are services that enable individuals and entities to create, store, preserve, grow or move financial assets. We also define capital markets as a conceptual aggregation of transactions of at least one of two types. The first type, which covers more than 90% of transactional volume, is the trading of fungible forms of financial assets. The second type involves transactions where capital is allocated from savers to users in a disintermediated manner. Next, we will link the concepts of financial products and capital markets. We define financial products as services that enable individuals and legal entities to create, store, preserve, grow or move financial assets. Alternatively, we can classify financial products by whether their primary role is to facilitate capital market transactions or not. The ones that do, we will call capital markets products. We can use the term core banking products to refer to all other products. Sometimes, people use the terms Wall Street versus Main Street products to distinguish between them. A simple comparison is between brokerage account and a bank account. Both products serve the purpose of storing financial assets. A brokerage account is used to store cash and securities for the purpose of trading in capital markets. On the other hand, a bank account stores cash for savings and operating expenses. In our taxonomy, the brokerage account is a capital markets product while a bank account is a core banking product. We are using the term core banking products to signify that these products are the primary revenue source of most banks. Only the larger banks sell capital markets products. Let us look at some examples of capital markets products. One set of products are performance-oriented, where the compensation earned by the entity selling the product is at least partially dependent on the outcome. Even if the relationship between the fees earned by the bank and outcome is not contractually defined, the bank's ability to win business depends on its ability to deliver differentiated outcomes. Investment funds and IPO underwriting are examples of such products. The other set of products are fees for service products. The bank performs a service and gets paid for it. Examples include brokerage accounts, trade execution services and custodian services. We will learn more about these products in a later lesson. On the core banking side, we can make the same distinction. Most loans are all performance-oriented. While there is no upside to these products, there is downside if borrowers are delinquent and the bank can end up losing money. Fees for service banking products include bank accounts, deposits and payment services. We have integrated our understanding of financial products and capital markets. We now need to incorporate entities within our framework of understanding. But first, we will take a minute to recap our understanding of the three types of entities within the financial services ecosystem. Type 1 entities earn majority of their revenues from the sale of financial products. Type 2 entities earn majority of their revenues by selling technology, information and data processing services to Type 1 entities. Finally, financial products can be sold or enabled by non-financial businesses. However, these entities are outside the remit of this Banking 101 course. We can now relate our learnings on entity types with our learnings on capital markets. Type 1 entities sell financial products, which may be capital markets products or core banking products. To avoid confusion, let us clarify the distinction between a Type 1 entity that sells a capital markets product versus an entity that participates in capital markets. We will take an example of an equity mutual fund, which is a financial product in our framework. The product seller is the asset manager who sponsors the mutual fund. The underlying financial asset that this financial product relates to is equity. The capital market participants are the buyers and sellers of the mutual fund units. Let us take an example of a more complex capital markets product. An airline company seeks to hedge against fuel costs. The financial product that addresses the company's need is a hedging solution. The product seller is the trading division of a bank. The financial assets that this product relates to includes a commodity futures contract and a currency futures contract. There are two participants. One is the airline company. For the sake of simplicity, we can assume that the bank is also a counterparty to the futures contracts. Hence, the bank, in this example, is both a product seller and participant, however these are two distinct roles. Type 1 entities can be categorized into three zones based on their relationship with capital markets products. In the middle, Zone A, are large banks like JP Morgan and Citibank, which sell the entire range of products from credit cards to complex capital market products. Included in Zone B are entities that mostly sell capital markets products. These include hedge funds, asset managers, private equity firms and venture capital. Zone C includes smaller banks, insurance companies, specialist finance companies like mortgage lenders. They mostly sell core banking products. That does not mean these entities don't participate in capital markets as participants. In fact, most banks invest large parts of their balance sheet in government securities. This is why the distinction we just made between capital market product sellers and capital market participants is important. Almost all banks participate in capital markets, but only the larger banks sell capital markets products. Just like Type 1 entities, Type 2 entities can be differentiated based on their relative focus on capital markets versus core banking products. Examples of Type 2 entities focused on capital markets includes information service providers like Bloomberg and Refinitiv. An example of a Type 2 entity focused on core banking product is the credit scoring agency, the Fair Isaac Corporation, which publishes the FICO score. Rating agencies like Moody's and Standard & Poor straddle both. This brings us to the end of this short lesson. Please review the summing up section and proceed to the next lesson.